So today we are looking at what is revenue and capital expenditure, differentiates between the two, as well as revenue and capital income, and then determine the various financial statements that accommodate these terminologies, okay, and the items that come under them. Okay, so we'll start with the capital income or receipts, Now, capital receipts refer to all monies received, okay, from additional investments by the owner. So if the owner brings in additional, we know already that the business owner would always bring in the initial investment, but in the course of operation, they may bring in additional investment, okay, which could sometimes be in the form of cash or equipment, anything. And once that happens, it is referred to as a capital receipt, okay, or capital income. Again, if we sell non-current assets, I need not go through what non-current assets are. I expect that by now we all are very conversant with examples of non-current assets. Okay, so once you sell these non-current assets, land, building, motor vehicle, it's expected that the amounts are significant, and so they are capital receipts. Okay, when you acquire a loan for business operation from the bank, nobody will go and acquire some small amount of money. And so that also represents capital receipts, okay? Now let's contrast it with revenue income or revenue receipts. Whereas capital receipts refer to these investments by the owners or from the sale of non-current assets, revenue income, okay, must first and foremost be earned. And how do we earn it? Okay, you have to earn it by rendering the service or delivering the product. Then you would have earned the revenue income or revenue receipts. Once that has been earned or received, and the transaction is in the normal course of business operation, again, the transaction that yields the revenue income must be your main operation. So if you are dealing in the purchase and sale of water, then your main operation is purchase and sale of water. And so any income received from the selling of water will be considered as a revenue income or revenue receipts, okay? Sometimes these receipts also come from other sources. So there are some businesses who have what we call some side incomes, okay? They have some have a building they are renting by the side, and so there will be rental income, okay? That could also become part of your revenue receipts, okay? Though it's not coming from your main business activity, it would also be considered generally as a revenue receipt or income, okay? If you are receiving commission for rendering a service, it could also be a revenue receipt. Okay, so these are examples of revenue receipts that you see, okay? And these occur largely from your main business. Then we have capital expenditure. When we talk about expenditure, so when we talk about receipt could be broken down into capital receipt and revenue receipts. We also have expenditure by the business, and that could be capital expenditure, revenue expenditure. What is capital expenditure? Okay, capital expenditure is any expenditure incurred to acquire, manufacture, or improve an asset for the purpose of earning income. So any expenditure that a business incurs to acquire an asset. So if the business decides to acquire a motor van, that cost of the motor van will be a capital expenditure. If the business acquires or decides to improve the motor van or the motor vehicle for purposes of business, that improvement, and when we talk about improvement, you are referring to, for instance, maybe changing the engine, doing body works and spraying all over. That one is a total improvement. Okay, we are not talking about just some body works tool that you want to, okay, it's rusting here, let me just do it. No, we are talking about doing a general body works and then making sure that that motor vehicle is sprayed. Okay, after that, that could capture, or that could be, okay, a capital expenditure. So once you improve, it could also be when you manufacture. So when you are putting up a new building, the cost of putting up that new building will be considered as a capital expenditure. Okay, so here we have the breakdown. If you acquire a non-current asset, it's a capital expenditure. Sometimes in constructing the building, the wages and salaries of the workers, okay, form a key component of it. And so that will be included as the cost of the building and would become a capital expenditure as well. Okay, because it would have been added to the cost of the building. Sorry, my son is calling me. Let me just quickly. Is it so? Sometimes the wages and salaries of the workers who are into the construction may be added as part of the cost of putting up the building. Okay, and that will be captured as a capital expenditure. Aside that, there are certain times also we incur some costs to bring the asset to its usable condition. So for instance, you go to buy a car, you have to register the car number plate, you have to register the car in your name, acquire a number plate. All that sometimes are included as part of the capital expenditure, the cost of acquiring the car. If it's about machine, then you are talking about being able to move the machine from the warehouse, okay, the cost of moving it to the factory, then sometimes the cost of even installing the machine may also, okay, come in as capital expenditure. So all these, the intention is to bring the new machine into its usable position, and so will qualify as a capital expenditure. Okay. Now, what are the features of a capital, additional features? The intention of engaging in a capital expenditure, okay, is to use the asset to earn revenue. We talked about revenue income. So that asset that you have spent so much on, you are going to use it to generate revenue, okay? So capital expenditure would always be used to earn revenue for the business organization. Again, capital expenditure normally, okay, results in benefits that span over many years. Okay, once you incur a capital expenditure, the benefit from that capital expenditure should be generated, okay, or the benefit from it to the business will transcend one one financial year. And so that is capital expenditure. Okay. Now, there are certain types of revenue expenditure, which though they are revenue or are mostly considered as revenue, sometimes may be considered as capital because of the amount involved. And an instance is adverts. Okay. So when you have an advert program where the advertisement is for a whole year and includes so many aspects of the business, or you are introducing a new business and you have to do a lot of expenses at the formation stage of the business, then all that could be classified as capital expenditure. If you have to pay off a loan, remember, acquiring a loan is capital revenue or capital income or capital receipts. So why? Because of the value, the amount. In the same way, if you have to pay off the loan, that amount you pay off will not be something very meager, it will be some huge amount. And so that would also be classified as capital expenditure. Yes, Kwesi, Justice.
Madam, please, how about the interest on the loan?
The interest on the loan will be a revenue expenditure. Well, depending on the terms, okay, there are some that will tell you that you should add, or there are some that add the interest to the loan and you pay all together. There are also some loan agreements that suggest that you pay the interest separately and pay the loan. So when you are paying the interest separately, it is regarded as a revenue expenditure. So interest is revenue expenditure. Are you okay? Okay, so that is it. So we'll look at revenue expenditure. A revenue expenditure is incurred for the purpose of maintaining the non-current asset or the earning capacity of the business. Let us remember that capital expenditure is mostly on non-current asset. So how do we maintain that non-current asset in order for it to generate revenue over a number of years? We cannot assume that because we have just acquired it, we don't need to maintain. Otherwise, the non-current assets may break down. And I'll give you an instance. Motor vehicle, buildings. When we buy a motor vehicle, what do? On a quarterly basis, you need to do maintenance. Every day you have to buy fuel. You have to do insurance. These are revenue expenditures with the purpose of maintaining the motor vehicle. If you put up a building, okay, occasionally bulbs are dead. There are cracks somewhere, you may have to maintain it, okay? You may have to be doing some slight changes as you go along. Along the line, you may change a few. So the bulbs that you change may be a revenue expenditure. But if you have to paint the whole building, okay, sometimes the cost of painting the entire building may become a capital expenditure. And that will be seen as an improvement to the building because of the cost. So if you were just painting one office, it may be seen as revenue expenditure. But if you have to paint the whole building, then that would be a capital expenditure because of the amount. So take note of the keywords I'm using. Okay, you can go to MCQ and it just gives you the difference. Improvement and maintenance. Improvement would always result in capital expenditure. Maintenance will result in revenue expenditure. So please, these ones are English language. Just note them that anytime the transaction is talking about improving the item, non-current asset, then it is a capital expenditure. And I gave you an example earlier on where you are doing well, you are spraying the whole car. Okay, it seeks to improve it. If you are painting the whole building, it seeks to improve it. So that will be captured under capital. But if you are changing bulbs for the building, within the building, that is revenue. It is for the purpose of maintaining the earning capacity of the non-current assets. Okay, so take note of that. Now, one thing you must note with revenue expenditure is that it is incurred in the normal course of business. So on a daily basis, you are incurring the revenue expenditure, and it's constantly in the course of business operation. So every day you are buying and selling water. If that is your main business, you would always earn and incur revenue expenditure. Either because somebody is buying, you have to carry, so you pay some wages, okay, or you have to buy some carrier bag and put the water in. These are expenditures that are incurred in the normal course of business. And it is consumed in the period in which it is incurred. Remember the matching concept. Okay, you must match revenue to cost or expense. Okay, so once you earn revenue income, you must also match its related expenditure. Okay, so that is what we must take note of. Now, what are the relevant financial statement entries? Okay, or which records, which financial statement reports do we record these ones? Okay, anytime it's a capital income or receipt, you know that like any transaction, the owner brought in additional cash. How will you record it? Okay, the owner brought in additional cash. How will you record it? Who would answer it for us? The owner brought in additional cash. What is the double entry?
Madam, please, you debit
Yes, yeah.
you debit the capital of the owner, and you
That's yeah.
you
The
you debit.
owner brought in additional cash.
Madam, you debit the cash book.
And credit what?
And credit, Madam, I don't know.
Capital account.
Oh, yeah, so you started well. Double entry, we have done it over and over again.
Madam,
Okay.
you debit your cash.
But this
Your cash account.
Yes, if the
Yeah,
owner
Madam, you debit the cash, you credit the capital.
Yes, if the owner brings in additional cash, what represents the owner in our books is the capital account of the owner. Okay, so if the owner is bringing in additional cash, the business is receiving it. So our cash will increase and the owner's interest will be credited because that is, okay, that is capital, and capital account has a credit balance. Okay, so when it is capital income being brought in by the owner, okay, we would always credit the capital account of the owner. Now, if we sell a non-current asset, which is not material, meaning that the amount is not so huge, then we'll credit it to the income statement. Okay, but if the amount is huge, then we'll treat it as part of equity. Okay, we know that equity is capital plus retained earnings plus reserves. So we treat it as part of equity. Okay.
Madam, so which ledger would the capital account be? Is it a private or?
Capital account. If it's an individual, it's a personal account.
Okay.
Okay, it will be treated, it's a personal account. So it will be treated as under the, but you see the capital account may find itself in the general ledger, but it takes on the character of the purchases ledger because it has a credit balance. Do you get it?
Yes, madam.
Okay. So revenue income, okay, we have already described revenue income as income from our main source of business. Would always be sent to the income statement, will be shown as sales or revenue the year that they are earned. Here again, the matching concept. If we sell this year, the amount of money we earn, we must record it in our income statement. I've already told you that for you to record revenue income, you must first earn it. And you can only earn it when you have satisfied the requirement. So if you are buying and selling water, the only point you say you have earned is when you have delivered the water, okay, for which you have been paid, then you have earned that revenue, okay. Of course, sometimes we deliver and then we are paid later, but the mere fact that you have delivered means that you have earned it, even though payment has not yet been made, okay, so you must earn it. Now, there are times revenue is, the amount is received, but you have not yet earned it. Okay. You have received the amount, but you have not yet earned it. So let me give you an example where perhaps you are selling water. Okay. Somebody, a customer, comes and says, look, I have this amount of money. I want to buy water. You say there is no water. And the customer says, look, let me deposit the money and go. When you finish manufacturing, let me know, so I'll come and pick my packs of water. At that point, you have received the money, but you have not yet earned it because you have not supplied the water. And so if you were preparing financials at that point, okay, then that money you have received, you will treat it as a current liability. Okay, you will treat it as a current liability because it is money belonging to third parties. And that third party is your customer. And you haven't fulfilled your portion of the contract. So you have not yet earned that money. Okay, so you show it as a current liability because in a short time, within the next 12 months, you would have earned it. You would have supplied the goods to earn it. Okay, but if it so happens that at the end of the period that hasn't been done, then you have to treat it as a current liability. Okay, on the other hand, where you have earned the income, but you have not, okay, received the amount. So for instance, you recall that when we sold to Ascertain, okay, when we sold to Ascertain, we realized that we have earned it, but we have not received the income. But these are other incomes, okay? And when you earn and you have not yet received, you show it in the statement of financial position as a current asset. So the name given to it when you have earned, okay, and you are yet to receive is owings, okay? The customer is owing you. Aside the goods, sometimes if you have earned but you have not yet received, then we say the customer is owing you, and that is why we treat it as an asset. And when you have, the customer you have received but not yet earned, okay, it is a prepayment, okay? So these are the two issues. But even if you don't, you realize that when we sold to Ascertain, and Ascertain had not yet paid us, that amount at the end of the period will be treated as a current asset under debtors, okay, in the sales ledger. The total of all the people we have sold to on credit, it means we have earned it, but we haven't received the cash. okay, will be shown as debtors under current assets. Here again, we expect that within the short term, which is within the next 1 year, they would have paid, okay, their amount owing. Okay, so that is with income in the financials. What about capital items? Now for capital expenditure or capital issues, okay, capital expenditure is shown in the statement of financial position as a non-current asset. So for instance, we bought motor vehicle on credit. The business bought motor vehicle on credit. Definitely we will debit motor vehicle account in a statement of financial position accounting equation. Okay, and credit cash, if that is what it is, if it's cash. If it is bank, we'll credit bank. Okay, so that is it with capital expenditure. Anytime we buy capital expenditure, we show it as a non-current asset in the statement of financial position. And on a regular basis, the portion of it that we consume, we treat it as a revenue expenditure. I've already told you that the portion that is used, the cost incurred, the amount incurred to maintain it, is also treated as a revenue expenditure. Electricity bill, water bill on a building, maybe fuel on a motor vehicle, maintenance on motor vehicle, insurance. These are revenue expenditure. But the amount we spent to acquire the capital item is the capital expenditure. And that will be reflected in our statement of financial position. But in maintaining it, we refer to those maintenance costs as revenue expenditure. And that is written off in the income statement. Okay. When a portion of the capital expenditure is also being used in any revenue, that depreciable portion is referred to as depreciation. We'll see it shortly when we talk about depreciation. Okay. For revenue expenditure, it is shown in the income statement. So repairs, maintenance, fuel cost, electricity bill, insurance, these are expenses that fall under revenue expenditure and are shown as expense in the income statement as they are consumed in the year to generate the revenue. And so they must match the revenue for which they were spent, okay, for which they were incurred. So it must be matched. Okay. Now, such expenditure acquired or paid for but not consumed. So there are times the expenditure that is incurred, okay, we may pay for it, but we have not yet consumed. So I give you an example for most of you. Okay, your hostels, your parents have paid for it. But they have paid for it, I'm sure, to the end of May or early June. But if we're preparing financials as at 30th April, then you have not consumed that portion, okay, though you have paid. So in the same way, if a big business has paid electricity, prepaid, it means they have paid, but they have not consumed it. And that portion that they have not consumed, if we can quantify the portion, it will be treated as an asset because it is money, their money with electricity company. They are yet to consume that portion of the electricity, though they have paid in advance. The same thing we do with our prepaid mobile, whatever, cards. So those of us all on prepaid, okay, it means that we pay before we consume. So if we were preparing accounts, if it is a big organization, then that portion, if we can determine it with some level of certainty, we would have to treat it as a prepayment, okay, as a current asset, because the money belongs to us as at that point, okay, as at that point, okay. On the other hand, sometimes we also consume the expenditure, and yet not paid as at the end of the accounting period. So water bill, okay, most often we do postpaid. We enjoy the water before we pay. So if a business is also on a postpaid water bill, then the amount of water bill they have incurred, they'll have to estimate it and include it in their financials when they are preparing the financial reports as a liability, money that belongs to Ghana Water Company, but they are yet to come for it. Okay, so it will be a current liability. It means that that amount that is shown there belongs to Ghana Water. They are yet to come because we have consumed, okay, that expense. We have consumed the service. The water has flowed, we have used it, so we have consumed it, but we are yet to pay. So now the reason why the business captures all these in their financials is to know holistically the financial position of the business at the year end. And if you don't capture this and later people come, then we are not showing a true picture of the state of affairs of the business in financial terms. And so it's very necessary that all these things are captured in your records, okay? Those that you are yet to pay, that you have overpaid and are expecting to consume, you must let the shareholders know, okay? So they have a holistic view of the business at that point in time, okay? So that brings us to the end of this session. I expect that we should be able to distinguish capital receipts and revenue receipts, and also capital expenditure and revenue expenditure. Any question? This is a fairly straightforward one. So if we don't have any question, then we'll have to do week 10. Okay. Now, we have just talked about capital and revenue expenditure, as well as capital and revenue income. Like I did indicate, not really computational, but when we do the next topic, okay, I'm sure all that will come together in a question from now going, and we would have to identify the items and where they have to be recorded. So we know that for all revenue, expenditure, and income, they go to the income statement. For all capital, expenditure, and income, they go to the statement of financial position, okay, with a few exceptions, okay? So that is one thing we must note. Now, we would want to talk about tangible non-current assets, okay? And we know non-current assets are assets that span more than one accounting year. And so this session, we want to introduce students to methods in accounting for the tangible non-current assets. Again, I expect that most of us by now know what we mean when we say non-current assets. The only thing here is that we are focusing on the tangible ones, those that we can see, those we can touch, those we can feel. At the end of the session, we expect that students should be able to determine the value of the tangible non-current assets, identify the methods of depreciating these non-tangible assets, learn how to calculate depreciation using the two most widely used methods. Of course, that tells you there are others, but we will be focusing on just two. And then learn to make entries for depreciation in the books. These are reading lists. Okay, we can always make reference to them. Now, how do we account for non-current assets? Non-current assets are those assets that have been acquired for use, okay, and their usage will be more than one accounting year or one calendar year. Now, just from what we learned, we realized that, or we know that non-current assets are incurred, okay? The expenditure incurred is known as the capital expenditure. So anytime we acquire a non-current asset, then we have incurred a capital expenditure. We also know that when we incur a capital expenditure, we debit the non-current asset and credit whether cash, bank, or whoever sold it to us, okay? And that entry goes into the statement of financial position. Now, in contrast, revenue expenditure is expenditure that is consumed within the year. And that revenue expenditure every year exists for only 1 year. Capital expenditure, you would see the value or the amount of that capital expenditure beyond one financial year. And so we must take note of that, okay? Again, we must note that capital expenditure on these non-current assets occur once a while, not very often, okay? Revenue expenditure would always be incurred year by year. And examples of the revenue expenditures have been given. I've already stated some of these: rent, insurance, advert, and so on and so forth. Now, how do we determine the value of the non-current asset when we incur the capital expenditure? Okay, we would realize that one of the key amounts is the purchase price. So if we go and buy a motor vehicle, we know the cost of the motor vehicle is the purchase price. But sometimes, or we buy an equipment, it is not only the actual cost of the equipment. Sometimes the cost that we have to incur to move the equipment from one end to the other is also referred to as a motor carriage inward cost. Okay, so the amount we spend to move that non-current asset, that tangible non-current asset, to its place of location would also be part of the cost of the asset. Again, and I think we made reference to this in the earlier topic we treated on capital expenditure, that any additional expenditure that we have to incur on that non-current asset to make sure the asset is working is also part of the cost. And I remember I cited, okay, sometimes if you have to register the car, if you have to acquire a number plate, all that, if we are recording it for business purposes, would be part of the cost of the asset, okay? So if it is building, then you would have to, okay? If it is equipment, then sometimes the setup, how we have to set up that equipment, the cost would also be included as part of the cost of the asset at the initial setup stage. So again, take note of these three. For purposes of your multiple choice, it's possible some questions may pop up asking you, okay, what comprises the cost of an asset, a non-current asset, and you may have this, that, and have an odd one. You must be able to know that. So please take note of that. Okay, these are, when it comes to the theory aspects, sometimes these are the basic things, okay? And I'll keep drawing your attention to them as you go along. Okay, and that doesn't mean that everybody is going to get it. I told you that we are setting a lot of questions. The only thing is, I don't know which question will go to Joshua. I don't know which questions will go to Yardan. So I don't know which question will go to anybody. Okay, so all you have to do is to go through all as often as you can, knowing that you can be able to identify it if it comes to you. If it doesn't come to you, it is well. Okay, so that is just it. Because Once we input the questions, the system automatically generates questions for each student. And that one, it is not within our purview. So please take note of that. Yeah. Now, so these are the values of the cost in determining the cost of an asset. Okay. Now, one key concept when it comes to tangible non-current asset, one key concept that you would always find, okay, associated with tangible non-current assets is the concept of depreciation. The concept of depreciation. What is depreciation? Okay, the standard gives us some definition. It says it is the systematic allocation of the amount of an asset. So you have acquired an asset for 100,000. You need to allocate that amount over its useful life. Let us remember that we said that you must match the cost to the revenue. Now, when you acquire an asset, you make an initial huge investment. Meanwhile, that asset will generate revenue over a number of years. Now, if we are using the matching concept, then we expect that over the number of years that that asset will generate revenue, you must match the revenue to its cost. But you realize that with tangible non-current assets, we invest the amount at the beginning and then it is earning revenue. Now, in order to help us allocate that amount over the number of years, that terminology, okay, is what we refer to as depreciation. So depreciation is just the systematic allocation of the amount over the life of the asset. Now, you and I cannot determine the life of the asset. We would always have to estimate the useful life based on our business principles. What a business can say is a useful life, another can say mine is more than. So useful life here means that how many years will that asset be useful to the business in generating revenue? For somebody, the same asset, a business could say 4 years. The same asset, another business could say 6 years. It depends on the policy of the business. It depends on what conditions the business are looking at. Okay, so we cannot say it, but every business would have to estimate the useful life of its non-tangible, non-current assets, the tangible ones, every business, and then allocate systematically, okay, the amount it has spent over those number of years. In other texts, okay, depreciation is described as the measure of wearing out, the consumption or reduction in the useful life of the non-current assets, either through use, so as you use it, it is wearing out. How do you replace that non-current asset? So as you use it and you have invested, you need to set aside some amount of money so you can replace it. At other times, you want to quickly allocate the value because after a while, that asset will no more become useful, either because there's technological improvement and so that becomes a useless one, okay, or the market for that particular equipment does not exist any longer. And so you want to quickly allocate the amount over a number of years. So all these things will be factored in determining the useful life of the assets. Okay, so if technology will have an impact from the business perspective, then you have to factor it in and determine with precision how many years technology can help. If after 2 years that asset, technology will take over, then if that is your decision, that becomes the policy to allocate that asset the amount over 2 years, and that is a policy of the business entity. Okay. Now, what are the causes of depreciation? The level of usage. If you use an asset over time, most of you, I think, bought laptops maybe last year because of all this. I'm sure for you students, your parents expect that till you finish, they are not buying laptops. In the business world, of course, they would also do the same thing, but they have to look at the usage. How often are we using the laptop? Let's also be mindful that for some people, within a few months, the laptop can spoil. That is also there. But we expect that these ones can work over some time. And so the level of usage would have to be estimated. Then the passage of time, okay? Now, for some of you, the laptops that you bought were very basic. Of course, you are business students, so you don't need any sophisticated one. But if you are a computer science student, if you are some engineering student, perhaps you require more sophisticated ones. And so with the passage of time, okay, this laptop or the basic one you have may not assist. So may not help you in fulfilling your studies online or even for your practical purposes. Okay, so sometimes the passage of time, okay, also influences why businesses would have to allocate the amount over the useful life. And that would also determine the number of years they determine as the useful life of the asset. Technology and the market would also have an impact on determining that, okay? Now, any portion of the non-current asset that is determined as having been used or consumed becomes an expense. So anytime we allocate that portion, what we are assuming is that it has been used. Remember, we are matching it, and we have already made a statement that the expense must match the revenue. So for the asset that we have bought, that we have determined the useful life. If we determine that the useful life is 5 years, and so based on that, every year we are consuming maybe 20,000 of it, then that 20,000 becomes an expense, because at the end of each year, you would have consumed that, and it will be recognized as an expense, a revenue expense in the income statement. Okay, now how do we determine and charge depreciation where we are not given? You'd have to determine the cost of the assets. You would have to determine the estimated useful life. I told you that you will not find anywhere. The business or the business entity must determine its useful life based on its circumstances. So you may go to one company, the same assets, the same thing, but their useful life is different. It is an estimate, because truly nobody can really determine the true useful life of the asset. So that is why we say it is an estimate. Then we also have to estimate the amount that we expect to remain on the asset cost at the end of its useful life. And that is the residual amount. Okay, based on that, we can determine the depreciation amount to charge. And so let me quickly do that and see. Let me see. Okay, so here we have, so let me just put a simple question. For instance, we have the cost of motor vehicle to be 100,000 cities. And then we have the residual value. So we expect that, so we expect the useful life, that the motor vehicle that we are buying, we hope to use it as a business, because for 5 years, meaning that within 5 years, as a business, we feel that this is the number of years the motor vehicle will serve us well, that we can gain value from the use of it. Remember, non-current assets are used to earn revenue. So we think that within 5 years, we should be able to earn the maximum revenue from the use of the motor vehicle. And at the end of the 5 years, we expect that the value standing would be some 10,000. Now, what amount of depreciation do we charge every year? Okay, how much do we charge every year? Okay, on the motor vehicle to be able to allocate the amount. So it's going to be the 100,000 minus the 10,000. Okay, divided by 5 years. How much does it give us?
18,000.
So our depreciation amount over the 5 years, it means that on a yearly basis, we should be allocating 18,000 as the cost of the motor vehicle as an expense to our income statement. Okay, it means for the next 5 years, every year, okay, the amount of the motor vehicle would have consumed will be 18,000. Yes, Paul.
Yes, madam, please, is there a situation where they will not give you the residual value? How will you find the rate of depreciation, or how will you charge depreciation?
So if you're not given the residual value, you assume it is 0.
Okay, so you just divide the cost over the number of years.
Exactly. If you are not
Okay.
given the residual value in an exams or in anything, okay, you make an assumption that it is 0.
So, madam, if we divide it that way, would that be the percentage you'll be using, or you
We have
will
put
just
value
subtract?
here.
Pardon?
We have put the amount here.
Yes, I mean, if let's take it that the cost is 20, and you divide it by the number of years 5, or let's take it that the cost is 10, and you divide it by the number of years 5. So that would be, you get something like 20. So is it 20%, or that would be the total amount you'll be subtracting from
That will be
cost?
the total amount.
You'll be subtracting from the cost to get the depreciation.
No, that is the depreciation.
Okay.
That is the depreciation. This is what we have calculated.
Okay. So that means
Okay.
that's the depreciation for each year.
For each year, exactly.
Okay.
So we are saying that this is the amount of the motor vehicle we would have used every year that we have to match to the revenue the motor vehicle is generating.
Okay. Thank you, madam.
Okay, Lowell.
Yeah, madam, please, I couldn't see the workings that you were doing.
Can you all see the workings?
No.
No,
madam. No, madam.
No, madam.
When I did the
No.
No, madam.
It's okay.
We can't
I
see.
did.
No.
We can see.
No, madam.
When I did the new share, I thought you would have seen it.
No, madam.
Okay, yes. So it means so can you see it now?
Yeah, yes, madam.
Yes,
madam.
So that is the depreciation amount. So this is the amount we will be allocating, okay, to represent the consumed portion of the motor vehicle that we would have invested in, okay? So that is depreciation. So now there are various methods. Okay, there are various methods that we can use in applying on the type of asset and the usage, okay, based on the different assumptions. Based on the different assumptions that we'll make. So the most commonly used methods, which we are going to be focusing on, is what we call the straight line method and the reducing balance or the diminishing balance method. If you look beneath, there are other methods: the sum of the years digit, the revaluation method, the machine hour method, and the depletion unit method. Again, it is expected that you have knowledge of these for computational purposes. Okay, we would be focusing on these two. But for theory purposes, and because you may be doing multiple choice, it may be necessary for you to know the other methods. Okay, though for computation, we are going to just be focusing on the two main or common methods. Now I'll take the first one, the straight line. The name just spells it out. It is a straight line, a common figure. Okay, so this method is based on the assumption that the asset would be used equally over its useful life. So if you look at the example that we just worked, that is the assumption there, that the 18,000 we computed would be consumed every year over the next 5 years. And that is what we just did. So under this is how we compute this is how we compute the depreciation amount. Okay, the cost minus the residual value, and that's just what we did. So that is a straight line method, which is assuming that the assets that we are using will be consumed across their useful life at the same level. And so the 18,000 every year, that is the allocated amount of what we will consume. Okay, and here we have an illustration similar to what we did. The cost of the motor vehicle, the estimated life 5 years, the residual value, okay, and then the and then we have just a minute. And then we have the annual depreciation. So here, the 500 minus the 50, giving us a depreciation amount of 90,000. So what we are saying is that on a yearly basis, for this motor vehicle, we will consume 90,000, irrespective of how we use it. That is the assumption we are making. Okay, and I told you that for these methods, they become a policy. It is a policy issue. Okay, it is a policy issue. So nobody can go and say, look, this motor vehicle should be no. It is a policy issue. The only thing is that once the policy has been adopted, we go back to consistency concept. It must be consistently applied by the business till they decide to change. And when they change, they must apply it consistently. Okay, so this is a policy. If you decide you want to allocate the same amount over its useful life, that is a decision of the business, and accountants will respect it. Now, the other one is what we call the reducing balance method. Okay, for this method, the assumption is that we will enjoy more value from the assets in the earlier years of usage than the latter years. So for the motor vehicle, the earlier years, you may use it more often and there'll be more value. Okay, there may be less expenses on it than the latter years. So because of that, let's take more charges in the earlier years than the latter years, okay? So that is the reducing balance. So it reduces as we go along. The value, the amount to be allocated reduces as the years go by. Why? Because in subsequent years, the value or the benefit we are expecting okay, from the usage of the assets may also reduce. So we equate the benefits to the allocated amount, okay? So here is an example, okay? And to be able to determine that reduced amount, which we'll be calling the net book value. So in order to compute your depreciation or your amount allocated as depreciation, you must multiply the rate by the net book value. The question is, what is the net book value? Net book value is equal to, or the determination of the net book value is cost minus accumulated depreciation. So for instance, if we were using the 100,000, year 1 minus 18,000, year 2 will no more be 100 minus 18. It could be either 100 minus 18 or, year 2 would be the cost minus the net book value. Okay, so the 100 minus the 18 multiplied by the depreciation rate. That will give us the depreciation amount. Okay, so here we still have the example motor vehicle, but we have been given a rate and we are using the reducing balance method. So year 1, 20% times the amount, the cost, the original cost, which gives us 100,000. So year 1, we are expecting that the usage of the motor vehicle will generate more benefits than year 2. So in year 2, okay, the net book value will be the 500 minus the depreciation amount of 100, which is 400,000. So it will be the 20% times the 400,000 to give us 80,000. In year 3, okay, now the total depreciation will be 180. So the 20% times the 500 minus 180. So if we are doing 500 minus 180, that will give us 320,000, and that is our net book value multiplied by the depreciation rate. So you'd realize that as the usage, the time goes by, the depreciation amount is reducing, and hence the name, the reducing balance method. Okay, why? Because we expect that in year 3, the benefits from the usage of the motor vehicle will be lower than year 1 when we initially bought it. Okay, so those are the two methods. Now, how do we account for? What are the accounting entries? In accounting, even though we would understand all this, our main interest is how do we record it in the books.
Madam, please, the accumulated depreciation, how do you generate it?
Yes, Ben, are you asking a question?
Yes, madam. Please, the accumulated depreciation, how do you generate it?
The accumulated depreciation is just an addition of the depreciation over time. So if you look at year 1, it was just 20% of the cost of the asset, which gave us a depreciation, okay, amount of 100,000. Are you okay? In year 2, because we are reducing it, now what is our net book value? Our net book value is the cost minus the depreciation, because we only have depreciation for year 1. So in year 2, our net book value is this one, 400. Okay, if we were supposed to then our net book value would be what I have highlighted, sorry, which is the 400. Okay, that will give us our net book value. Now, our net book value times 20% will give us 80%. This 80% is our depreciation figure for year 2. So in year 3, if we want to find the accumulated depreciation, it is the depreciation in year 1, which is 100, plus the depreciation in year 2, which is 80, giving us 180.
Oh, okay.
Okay, then we take that from the cost of the asset to give us the net book value. Okay, and then we multiply the rate to give us our new depreciation rate. Are you okay?
Yes, madam.
Okay.
So, madam,
Yes.
madam. So please, for this example, like, we use sum all the depreciations to get the accumulated one.
Exactly. That is what I've just explained. Solomon.
So then we are going to have 244,000.
After, okay, if we're doing year 4. So if we're calculating for year 4, okay, so everybody should calculate year 4. Let's quickly in a minute. This one shouldn't take us too much. Year 4. Year 4. What will be our depreciation? Who will give us the figure for year 4?
Madam, 51,200.
51.
51,200.
Who else?
51,200.
Are we all getting 51,000?
1,200.
Okay, so if you are not getting 51,200, then check. Okay, so that is our 51,200 will be the depreciation for year 4. And if this asset, if this asset has a useful life of 5 years, then it means that we have to calculate year 5. So we'll continue till, okay. So if we don't have any number of useful life, I want to use it throughout, then we'll continue till we get to a 0. Okay, then we consume everything. It means we are using it till we feel that the asset is tired. So that is it. So we are allocating it continuously.
Madam, so in this method, you are not going to get 0 as like
of course, we will not get 0.
Okay.
We will not get 0 in this method. So how do we account for it? Anytime businesses buy non-current assets, I've already made that statement earlier on, that capital expenditure, your debit is sent to the statement of financial position. And that is a transaction we have talked about. So anytime we purchase non-current asset, what do we enter? We debit the asset account and credit the cash account, or the bank, or whoever we bought it from, with the cost of the assets. Okay, now when we charge the depreciation for the year, as we have done in these earlier ones, what do? We debit, so we open a new account known as the depreciation expense account. What balances have expense? Debit or credit?
Madam, debit balance.
Good. So once we know that it is debit, all expenses have debit balances. So depreciation expense account is debited. Okay. Then credit, we credit the provision for depreciation account. Remember, we took the money from somewhere to buy that non-current asset. And so as we systematically allocate the amount to that asset, we set aside that amount so that at the end of the useful life, if we decide to dispose it off and buy a new amount, we have some money we have set aside. Okay, so sometimes I tend to believe that depreciation is also allocating the expense, but also accumulating money to be able to cover the previous cost and buy a new one. So that money becomes the money you are using revolving to buy the asset. Okay, although maybe by the time you recover, the next one may be more expensive, but you have recovered the cost. Okay, so that provision for depreciation account is just anytime you see provisions, it is some set aside, amount set aside. So we would see provision for bad debt. Okay, it is just some set aside. Okay, for purposes of based on the systematic allocation of the asset costs. Okay, so you credit it, and because it is assumed that money is for a purpose, we treat it as a credit balance. Okay, so that is it. So you credit the depreciation account with the value. So the 51,200 you have, that is in the 4th year. So that is the depreciation. So you debit depreciation expense account and credit provision for depreciation with the value of the yearly depreciation. If you are preparing for the year, if you are preparing for 6 months, then you would have to. Okay. Now at the end of the year, so if we're doing monthly, then every month. So 51,200. If you are doing a monthly depreciation, then you have to divide it by 12 to get the monthly. But if you are doing a yearly one, then the 51,200 is for the year. At the end of the year, you would send the expense. So you have to balance the expense account and send it to the income statement because it's an expense. The balance on the provision for depreciation remains so because it's just an account to accumulate the amount we have spent. Okay, to recoup it. We have already spent it. Remember, we have already spent the amount. So we are just trying to recoup. And the recouping is through the income statement. So we see how we are faring. So that balance still remains. And so in order to determine the net book value, which will show on the statement of financial position, then we have to show the cost of the asset and less the accumulated depreciation to give us the net book value. Okay, and that would always be shown, okay, as under the non-current asset. So under the non-current asset, if we have motor vehicle, we have cost, less accumulated depreciation, then we have net book value, and that will be shown in the statement of financial position. Okay. Finally, now the same asset we are depreciating, at certain points, we can decide to dispose it off. Disposal just means to sell it off. Okay. Why? Because we don't want the assets to break down. Certain times we know that when assets, okay, after usage, if we leave it, it becomes cost to us because you have to store it somewhere. Okay, if it becomes obsolete too, it is no more useful. You have to clear the obsolescence. So all these things, okay, are costs to business, and business want to reduce costs. And so what businesses do is to dispose of these non-current assets at certain times, especially after the useful life. Okay, after the end of the useful life, they dispose it off. And so when you want to dispose it off, what entries do you pass? Okay, now you have to move that whole asset values to the disposal account. So you have to open a disposal account and move the values in. So you move the cost price of the assets that you have sold, okay, by debiting the disposal account and crediting the name. So if the motor vehicle, we wanted to dispose that particular one off, costing 500,000, then we'll have to credit the motor vehicle account to take it off, that particular asset. Okay, because remember, there may be so many motor vehicles. So if the particular one that you want to sell or you have sold, you have to remove the total cost that you included when you bought it. So you credit the non-current asset account, okay, and debit your disposal account. Because you have also been systematically allocating, okay, some amount to it, you go back and you debit your provision for depreciation. Remember, provision for depreciation, when it was taken out, you credited it. So if you want to also take that out, you debit it, okay? You have the depreciation already charged. So those that you have already allocated, you debit the provision and credit the disposal account. Now, because you have sold it, you would have received some cash. And as usual, okay, sold motor vehicle, sold the motor vehicle costing 500,000 for maybe 100,000 cedis cash. You would have received cash into your cash account and you credit your disposal account. Now, the purpose of the disposal account is to determine whether that motor vehicle, even after usage and after selling, whether you are making a profit or loss on disposal it off. So you are taking the cost minus the depreciation, the amount you have already allocated. Now we must note that if your cash, the amount received is more than the balance standing on your disposal, the cost column, then you have a profit on disposal. But if the cost price of the asset is still more than the provisions and the amount you have received, then you have a loss on disposal. It means that after using it, you made a loss. Of course, it all depends on how you bargain, I keep telling you that when you hear Game and all those people doing buy one, get 10 free, sometimes it's not because they think you are nice, or they want to be nice. It's because the assets are becoming obsolete. The items, when you leave them, when they become obsolete, you have to discard and you have to incur costs. So you had better quickly dispose them off. So the same thing happens to non-current assets. When it gets to a point, you have to just dispose it off. So how much you realize on that amount that you are disposing it off and in that condition, so you realize that most often businesses don't refurbish, they sell it as it is. Especially motor vehicle, computer equipment, air conditions, they sell it as it is. So how much they realize, because they have used it, they have enjoyed the benefit. So that is just an added on to recoup part of their money. If they're able to sell it more, it's fine. If they don't, it will reduce their profit, but it's fine with them because they would have used it. Okay, so that brings us to the end of today's lecture. We have about 17 minutes more to end the class. I have another class. Today it is back to back. I have an MBA class. It's supposed to even start at 5. I've moved them to 5:30. So we have about 20 minutes. I'm going to explain the question. We would go and complete it. And God willing, next week, we'll quickly go through it before we start the topic. Any question on this? I guess this is becoming friendly. Or it's not friendly?
It is. It is.
Yes,
it is.
it gets murky because you don't understand. Then as you get the understanding, it becomes a bit friendly. So quickly, the question, I think, at least now most of you understand certain aspects. So when I mention key terminologies, when I mention things, it's becoming familiar territory. Words. So
We are trying.
Ben has sent you the question, so please quickly take it and let's go through. We will start, we won't complete because there's no way we can complete it. Question before we start some entries. Okay, Ben, some people want you to send it to the WhatsApp group. So question 2, question 1 is some theoretical questions. I expect that we'll go through it. Okay. Question 2 says the information below was extracted from the books of Let Your Light Shine Enterprise. So the non-current asset is machine A, B, C, D. The cost price of the machine has been captured here. We are assuming that it includes the cost, the purchase price, the carriage and everything. Then look at the dates that they were acquired, Okay, various dates are there. And then you realize that machine A and C were disposed of along the way. Okay, and these are the proceeds, the amount they realized from disposing it off. Additional information, okay. Now it says, as per the enterprise accounting policy. So you realize that it is a policy, and I've mentioned it. Yes, before I even continue, in the previous class, somebody asked, and let me just use this to also draw attention to it. Madam, would you always be told which of the methods to use, whether straight line or diminishing balance? And if you are not told, what do you do? And my answer was that if you are not told, there will be a statement that should give you an indication of which method to use. So for instance, if you have a statement like, it is the policy of the company, of the business to allocate, okay, depreciation equally over the useful life of the assets, which method are you supposed to use?
Madam, straight.
Straight line.
Straight line.
Exactly. So impliedly, that statement has given you an indication. So even though you may not say that the policy is to use straight line, but implied in that statement is for you to use straight line. If you have one that says that the policy is to allocate, okay, higher values to earlier years of benefits, or to allocate higher depreciation to earlier years, what is it?
Diminishing balance.
Diminishing balance. And so though the statement has not told you that it is diminishing balance, that statement implies. Okay, so please take note of that. Okay, I know that we may be doing physical exams, okay, for the final. So please just take note. That should happen. So even though you may not be asked, okay, to do, and I suspect that your final exam may have a full-blown financial statement. Okay, so these are some of the things sometimes you use to test students' knowledge. So they'll not tell you, they'll give you the amount, they'll give you the rate, they'll not tell you which method to use. That you would have to read as you read the statements. Okay, so that is it. So let's look at the additional information. As per the enterprise accounting policy, depreciation charged is prorated on the basis of month of use. This is telling you a story. Look at when machine B was bought. When was machine B bought?
January.
Are you sure?
January.
First July.
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 Good. Now look at when they say accounts are prepared. They say accounts are prepared to which date?
31st December.
31st
Every year.
1st
Every
December. So if you are told that depreciation charge is prorated on the basis of the month of use for machine B, how many months did you use it?
6 months.
6 months.
5 months.
5 months.
For machine B, we have used it for 6 months.
6 months.
Okay, so that should tell you that you cannot use 1 year for machine B. And that is why that statement is there. It is prorated. It means it is, okay, the amount is given based on the number of months of use. Okay, so take note of that. That is the first thing you would have to take note of as you compute depreciation. Then 2, all acquisitions and disposal are on cash basis. So that is telling you that when you are recording the costs, initial acquisition is on cash basis. Okay, that one you should know. Then B, machines A and B are depreciated at a rate of 20% on diminishing balance. Machine C and D are 10% straight line. Fortunately, this one has been given to us. So show the relevant accounts for machinery for the years to 31st December 2017. So it means we are preparing the records for 2015 December, 2016 December, and 2017 December. So the whole of 2015, January to December, 2016. So we are preparing the records, okay? So I'm going to go off and then show the income statement and the statement of financial position extract. So how much value will be represented there? You also have to show it. So let me quickly stop. You have your questions. So I'm going to be relying on you so that we can start the recording. So as usual, I'm going to rule. The name of the company. So I have the machinery account.
What's it?
Happy. We have the machinery account. So for purposes of time, I'm not going to put all the narrations here, date, blah, blah, blah. Please do it in your books. Okay, very important. Don't do it as I'm doing. I know how to do it. You may have a challenge, so do it as you have to do it.
Madam, but for the purpose of those who did not do accounting.
But for the purpose, that is why we are doing it, Ben. And we've been doing account preparing every time. So by now, I expect that everybody knows how to open accounts.
Okay, madam.
That is all I'm saying. So all I'm saying is I'm not going to put date, ledger folio. That's all I'm saying. Okay, so, and that one we have done it over and over again. So all I'm saying is I'm not going to put these details. If you want me to put it, we will not finish because it takes a lot of time. If all has to be done. So as for account preparation, account opening, it doesn't change. Okay, the information doesn't change. So anytime they say account, it's the same information. And for physical exams, if you have to prepare accounts, these details are always necessary and attract marks. Okay, that's one, let me just tell you. These details are always necessary and it will always attract marks. So we have our machinery account, we have our cash account. Okay, I'm not going to do that. We can have our provision. So we can have our depreciation
account,
expense account. And then we have our provision for depreciation account. Okay. So for now, we will have to do with these two. Okay, so please complete your information details as we go along. Okay, so let's go back. Give me the details.
Machine A.
Machine A, when was machine A acquired?
3rd January 2015.
So please remember all accounting will have to be in the books of somebody. So in the books of
Let your light shine.
So you have to
light
complete.
shine.
It's very important in the books of, okay? So when was machine A acquired?
3rd January 2015.
3rd January. So it means that 3rd January 2015, machine A. How did we acquire it? By what?
Cash.
Because the statement says that we should assume, okay, how much?
30,000.
30,000.
2,000.
What will be the other entry?
Cash. The cash book.
The cash book. So 3rd January 2015.
Machine
Okay.
A.
Machinery account.
30,000.
Machinery, then we can put A to identify it. Okay. 30,000. What else?
Machine B.
Machine B, when was machine B acquired?
1st July. 1st July 2015.
First what?
1st July 2015.
1st July
2015.
So it's also cash. 1st July 2015. Machinery into brackets B.
B. 40,000.
How much?
40,000.
40,000.
40,000. Okay. What else?
Machine C.
Machine C.
When was machine C acquired?
30th
September
30th September.
Okay, so
2015.
you have to do the double entry for machine B. So 1st 7/15, we bought it with cash. Amount is how
Cash.
much?
40,000.
40,000.
Double entry fulfilled. Then 30th September 2015, another cash.
Cash.
Yes.
60,000. 60,000.
60,000.
80.
We are all following. We are not allowed
It's machine C.
60,000.
60,000.
because this is just double entry we are doing. We are just doing the basic double entry. When we,
It's 60,000, not 600,000.
60,000.
it is what?
60,000. 60, then the 1,000.
60. Okay.
Yes.
1,000.
Okay, I hear. I'll change it.
Yes.
60,000. Okay. What
we
else?
have machine D. Machine D.
When was machine D acquired?
1st March 2016.
1st April 2016.
1st March 2016.
Okay. So we are supposed to prepare the account, okay, for each year. So if we have to prepare it for the end of each year, it means that for machine 2015, we have to draw a closing balance. Okay, for the year ended 31st December 2015. So 31st 12/2015, it will be balance what?
Carry down.
Carry down. How much will it be?
130,000.
Okay, so we have 130,000 here. So for 1st January
2016.
2016. Balance
Machine.
down. Okay.
130,000.
130,000.
It will be 130,000. Are we okay?
Yeah.
Yes, please.
So we can enter the ones we bought for 2016. So you continue that. So that is it. The cash account too, if there is no other transaction, we have to bring it down. Okay, carried down, brought down, the same thing. Because we are supposed to prepare the financial statement for each year. Okay, so each year we have to show the transactions. Okay. Then we have depreciation. So we have to compute depreciation. So let me do some computations here. Computations or workings. So the first, machine A. For 2015.
We bought it on 3rd January.
What are we using?
Reducing balance method.
Reducing balance method. Okay, so for year 1 or 2015, what will be our, it will be 20% times what?
30,000.
30,000.
Times 30,000 times what?
12.
For how long?
12, yeah.
12, okay.
It's from January to December. It's from January to December. So I'm putting the 12 over 12 just to let you know that it is from January to December. Okay, so how much will be our depreciation for? Are we correct?
Yes, please.
So if we're doing the monthly depreciation, then it means this 6,000 will be by 12 months.
Yes, madam.
For 2016, who is disturbing us? Ohene?
6,000.
So our depreciation for 2015, which we will send to depreciation expense. Where is it? So we'll debit depreciation expense. So 31st December 15, provision for depreciation into bracket, machine A. Okay. It's how much? 6,000?
6,000.
6,000.
We come to
Then you
the
credit, yeah.
Yeah. 31st December 15. Depreciation. Machine A. So it's just double entry. And the double entry is in your books. It's on your slides. So all you have to do is to apply, take your slides and see whether what you are doing is right or wrong. So double entry. Are you okay?
The same apply to the rest of the edition.
So 2015. For machine what? Machine B. Can we do machine B somewhere here?
Yes.
Okay, so B. Okay, let me put it here. Machine B. Okay, what is it? What percentage? 20%?
20% reducing balance. On reducing balance.
Times what? What is the figure?
40,000.
40,000.
40,000 times what?
12 over 12.
Are you sure?
Hey, no, madam.
6 over 12.
6 over 12. Yes, 6 over 12.
6 over 12.
Madam, 6 over 12.
6 over 12 because we bought it on 1st July, and so we've been with it for just 6. How much?
6 months. It will give you 4,000.
4,000. Okay. So we would record 4,000 here. 31st, 12, 15. Provision for depreciation, machine B, 4,000. 31st December 15, depreciation B, 4,000.
Please, madam, I have a question.
Yes.
Please, why is it times 12 is 6 over 12?
Who will help our friend out?
Now I can help him.
Yeah, I'll answer.
Madam, should I help him?
Yes.
The reason why it was the 12, 6 over 12 is because we bought the machine B on 1st July. So that means from January to June, we didn't have machine B. So there will be no depreciation for machine B from January to June. So it will be only depreciated from that 1st July to December for 2015 and onwards.
Sure.
Are you okay?
Yes, madam. Thank you.
Madam.
Okay,
Thank
so. Hey, Michael, be careful.
Sorry, madam. It was a mistake.
Quickly, my class, I have another class now. So 2016 is 20%. So let's look at this one. 20% times what?
Times 300 minus 6,000. 30,000 minus 6,000.
30,000
minus
minus
6,000.
Somebody is disturbing us. 1,000. Okay. And again, is it 12 over 12? If we
Yes,
want
madam.
Yes, madam.
Over 12. Michael Chumesi, if you are not
Yes,
ready
madam.
to the class. If your people are disturbing, to mute them or mute yourself.
Okay, madam.
How much does it give us?
4,800.
4,800. Okay. And for B here,
to be
20% times what?
4,000 minus 400.
40,000
minus 4,000.
minus 4,000. Okay. This time, what will it be?
Times 12 over 12.
Exactly. Times 12 over 12. And how much is it giving us? What is it giving us?
7,200.
200. 7,200.
How much? 7,000.
7,200.
7,200.
7,200. Okay. So, okay, I don't want to enter for 2016 because in 2015, there are other transactions, machines C and D, okay, have not been posted for 2015. So what I want you to do is to go and post the rest of the entries, depreciation for machine C and D, which is straight line and fairly straightforward. And then in 2016, we acquired a new asset here, which you'd also have to. You would have to also close the cash account, okay, for 2015, assuming these are the only transactions, okay, because we are going to be preparing, showing the balance on the cash account as at the end of 2015. So everything that belongs to the period 2015, you must enter it and bring the balances down. So go back, make sure that you have, okay, make sure that you have all the balances carried down in a very systematic way. If you don't do it in a systematic way, you will get confused, okay? So you have 130 here, 130 here, okay? And so 1st January 2016, you have balance brought down, okay, which is still 130,000. And then you can enter the cash transactions for 2016. So that if we have to prepare the financials for 2015, our cash balance for 2015 will be 130. Our machinery balance for 2015 will be 130. You see that if we're preparing the financial and the current assets, cash 130, non-current asset, machinery 130. But for the depreciation expense, we haven't completed it because of machine C and D. So go back and finish it. God willing, next week, we would quickly complete this, okay, and have the next class. Any question? Today I've been doing from 1:30, I'll close at 9 p.m. So don't.
Please, when is the IA?
Yes, the IA, I told you from the beginning that we have to set a lot of questions. Okay, because every student, the system will pick for every student. So if we set just a limited question, then it means that we have to ask all students to answer at the same time. And we've realized that that jams the system. Once the system gets jammed, it generates problem. Somebody was complaining the other day that they did it, had to do a second one. The lecture extended the time because they were answering limited questions. So we are looking at a lot of multiple choice questions, and every student will pull out, the system will pull out different questions for different students. So that involves a lot of multiple choice questions. So once we are ready, definitely, Ben, I think for you, I'm always on call with all the course reps. So once we get the green light, we would always pass the information. We don't expect that we'll tell you in the morning and then you start in the evening. No, I think that would be too harsh from us. Okay, so definitely there will be a few days notice for us to start. So just keep preparing, okay?
Madam, please, would the IA cover this topic?
I just keep learning. Okay, but this topic is very simple. It's not even simpler than the journal, the ledger entries. Paul.
The journal is plain.
Okay, get off my line. I have another. We haven't set the date. So, okay, so we cannot say that this